Scaling a CPG brand is exciting until things start to slow down. Cash flow can quickly get crushed, retailers can pull shelf space, margins can begin to erode, and you can quickly lose all the leverage that you've built, and it becomes hard to win back. Today, I'm joined by a fellow growth thinker and longtime partner, Priscilla Frick, a CPG and go-to-market expert. We're going to talk about how to defend shelf space, increase your sales velocity, and build long-term retail partnerships. Priscilla, welcome to the show.
Thank you.
You and I have been in the trenches on a handful of brands, and we really kind of see the world through the same lens. So I was hoping on this call that we can really just turn it into somewhat of a masterclass for anyone that's in the CPG space and they really want to understand go-to-market. They can better understand what to do when sales velocity slows down, things of that nature. All these things, we'll get into it. But, you know, the original title here was the CPG Growth Trap, How to Survive When Expansion Slows. But maybe we should put a flip on it, which is how to thrive when expansion slows.
I thought about that title a little bit, and I would say that survive is probably a little too strong of a word to say. Really, I think what I see happen a lot is that when you have businesses that are somewhat new to the CPG space, who haven't been working in this industry for a long time, the most important thing that people focus on is getting that distribution, getting the product out there. And that is commonly what people associate with go to market. It's just, how do I bring this product to the market, and that's it. But they take their eye off that ball, because once they get into the market, they're in the game, but then they take their eye off the ball, and it's not guaranteed that they'll collapse and not survive, but the statistics are that most new products that get launched don't survive. So I wanted to give some pointers on what people should do to avoid that collapse, to not get into that point where they have to dig out from being in the hole. So it's, some pointers on how to keep your eye on that ball.
Yeah, and that's important because it takes so much effort and energy to win your way into those doors.
And money.
It's almost like, and money.
Right.
Let's not forget money.
Yeah.
Lots of testing. It's almost like there's go to market, and then it should be the stay in market plan, right?
Yes.
It's like the STM. It's a stay in the market. So
Exactly.
let's talk about maybe some early signs. What is it that brands should be keeping an eye out for as early signs that you would see as red flags, being the expert that you are?
Velocity is probably the first one. That it's important to get in the door, but once you get in the door, you really have to watch that velocity, because in the CPG industry, you really only have about 6 months to prove yourself. And if your velocities are not sustaining, or if your velocities are not meeting the thresholds that are going to be the barometer of your success in the eyes of the retailer, that's probably the first signal. And the velocity then trickle down effect has a lot of other KPIs or metrics that it'll impact: your turns, your inventory levels, the cash that it ties up. So it's a domino effect that if you're not selling at the shelf once you get into the distribution, a lot of negative impacts are coming your way.
Who is giving the brands their velocity metrics? Where should they be looking to get these KPIs?
So there are a couple of different sources. The industry standard is going to be the POS data that comes from the Nielsen's and the IRIs of the world. But then you'll also, at times, for smaller operators, you'll get the sales reports directly from a retailer. And of course, you also have your own shipment data to see if the shipments are slowing or if they're growing. And you have to be cautious, though, to make sure that there's a difference between absolute sales growth and velocity. So you can still be growing your absolute sales, i.e. through distribution, new stores, new doors.
New stores,
But the products that are in the stores already on a per store basis may not be selling at that threshold level. So what you need to go after when you go to market is maintaining your absolute sales growth, but then also making sure that your sales in the stores where you're selling are reaching the target levels.
Okay, I'm not going to hold you to this, but is there a general percentage that you like to see of new doors versus recurring sales or velocity?
In terms of the difference between the turns and velocity, well, let's just say this. I don't think there's necessarily a standard break between, excuse me, between distribution growth or growth driven by distribution versus growth driven by organic sales in a store,
Yeah.
because it depends on how much you want to expand. So if you have an aggressive expansion plan, then you're going to
Hmm.
want to see a lot more distribution growth, and you're investing in that distribution growth instead of investing in that base velocity. What I would rather do, though, is there is
Hmm.
a standard metric that most people who have been in industry for a long time do monitor, and that is your velocity thresholds. That basically, relative to the other products in the category, if
Hmm.
you're not within the top 80% of turns in that category, you're going to be on the chopping block, because
Okay.
retailers generally target the lowest 20%, lowest 20th percentile in turner in everyday
Hmm.
turns to be items for potential discontinuance.
On a monthly or quarterly, semi-annual, what kind of review?
Generally,
Yeah.
minimum standard would be a 6 month evaluation, particularly since, they start looking
Okay.
at your health within 6 months. So I would say that in aggregate, your first 6 months, if you've been in the market established in a long time, let's just say, and this isn't even just a conversation just for new items. It could
Right.
be for established items that are at risk because there are a lot of new entrants coming into the category, and because of that competitive pressure, you're no longer performing potentially. So, in any given case, generally the evaluation period is 6 months or 1 year. When
Hmm.
the year mark is when retailers generally will have their resets or evaluations for the next year's planogram. So at that point, if you are falling in the lowest 20% of the turners, that's trouble.
That's good. That's good. It's good information. What kind of vanity metrics do you see brands commonly chase that is somewhat of a no-no in your eyes?
Top line sales for sure.
Hmm.
Top line sales in how much they are growing. And then when you start looking at more digitally based businesses or businesses that are selling through a lot of e-commerce, it'll be
Hmm.
new customers.
That's a good point.
Acquisition type of metrics is going to be another vanity target. Also traffic to a website. Those are some of the topical numbers that people will oftentimes, or brand managers or founders will cite as success. But when you start to peel those leaves away and you look underneath, those are really the health metrics, whether or not you are yielding sufficient profit for
Hmm.
yourself as well as for the retailers, and whether or not you're selling at their targeted benchmarks for velocity. Yeah.
When people start to see that maybe they're going to get delisted or they're on the chopping block, a lot of time brand managers or whatnot will start to scramble. So when they start to feel this pressure, they start being very reactive. What are some of the things that you see people commonly do that are reactive?
They start to pull back on investments in marketing, in consumer marketing,
Hmm.
and innovation. So one thing you will commonly see is that because they're not meeting their cash flow targets, because they're not meeting their profit targets, they will start to deprioritize innovation. They will
Hmm.
start to deprioritize consumer spending
Hmm.
and any strategic type of investments that are intended to grow the brand in the longer run. On the flip side, what you'll often start seeing is the band-aid approaches of throwing trade dollars or promotional dollars towards these brands to
Yep.
stimulate the trade, to stimulate the velocities, which absolutely should happen. That
Hmm.
if you are starting to suffer at the shelf, you should invest in some monies to increase those velocities again, but you have to do it wisely.
Yeah.
It needs to be done efficiently. And so I oftentimes will see that money gets thrown on the wall and they'll see what sticks, but it can be a very inefficient and expensive way of trying to save your product.
Are there some percentages or benchmarks that you would recommend in that category of spend or what you would throw at?
Well, if you're there's kind of a short-term answer and then there's a long-term answer.
Okay.
In the short run, with these, particularly with these type of band-aid approaches, and sometimes if you're trying to be a little bit more aggressive, it's not uncommon to get a negative ROI, that
Okay.
you'll actually spend more than you'll earn to drive that bump in your sales, to hold your place on the shelf, to get that lift. However, that's not sustainable, of course, because we're in the business to make money. And so if you look at it from a longer standpoint, it's really about that short-term investment, will it get you the long-term gains that you need? So within CPG, different categories have different rates of investment. The more commoditized the category tends to be means that the brand no longer matters as much and people start migrating towards the retailer's own brand. You might see higher levels of investment, say upwards of 30% or more. But in categories where there is stronger brand share, stronger brand loyalties, you may not have to invest as much to sustain your place on the shelf. So you might see, trade drop to the low teens in those types of businesses.
So is that a case, because this is always the push and pull between brand and direct response, is that a case for investing in brand? Because
Yeah.
a lot of people just like to invest, in ROI and direct response, the one for one kind of model. What's your perspective on investing in brand?
So as a marketer, I'm always an advocate of investing in your brand vision, investing in your brand. And I oftentimes like to use an analogy of a forest versus a tree.
Okay.
If you are investing only in your product, this one item, maybe two items, essentially you're just planting a tree. And you're hoping that that tree grows and develops roots and stays and has longevity. But what I believe is that from the very early stages, even before you get into market, I think a brand needs to invest in the forest to understand an individual product, or i.e. a tree, how that fits in your general brand vision. Because you need to invest in what this brand means to a consumer, not just this one product. You want to think about how this one tree can evolve into a couple of trees, a couple of varied types of trees, so that ultimately you develop an ecosystem where everything is dependent on the other. And you can grow that brand, you can grow that forest in a couple of different directions, and you can decide to plant a variety of different plants and trees so that the health of that forest sustains in the long run. Because it's a lot easier for a retailer to just chop a tree down than to kill an entire forest.
Yeah.
And it also helps a consumer to understand. So that, that was an analogy to talk about how you might be able to leverage or defend with retailers that might be considering your products for discontinuance or deletion. But then from a consumer's perspective, you want a consumer to understand, what is your brand about? The next product that this brand launches, I should have already trusted it to know, because I know what this brand represents. I will have a lot lower hesitation, and I will have a much lower apprehension to try if I know what this brand is about, and I believe what this brand is about.
Yeah. What is like one of your favorite forest brands? What would be a good analogy? Real life.
In the last few years, one of the brands that I've been so impressed with is Liquid Death.
Liquid Death. Tell me more.
Well, let's talk about what the product is. They sell water in a can.
It's water in a can.
It's water in a can.
Yep.
But how were they successful? It's because they weren't selling water. They were selling an image.
Yeah.
They're selling this image of the people who would be consuming this product. I am talking to the consumer's needs, which is, you want to look cool. If you've chosen to only drink water and you're abstaining from alcohol, you're abstaining from high sugar, high calorie drinks, you just want to drink water, but you don't want to look as uncool as holding a little plastic bottle. So that was what they were selling. They were selling an image. From that, they're able to branch out into a lot of other things that are relevant to that product, But now they're into energy drinks. Now they're into not just water,
Hmm.
right? But the
Right.
brand
Yeah.
image is the same. And so if I had been hooked by Liquid Death in the beginning when they bought just the water, well, heck, now I'm a lot more amenable to buying, okay, I'll try
Hmm.
that energy drink since I love this brand. I will still look
Yeah.
cool. And that's what I'm talking about. And so, for example, for a consumer, it helps me overcome that hesitation of trial with any new product that comes into the marketplace. But from a retailer's perspective, if you came in my door from day one when you sold me that can of water and you told me, oh, this is just step one, step two looks like this, step three looks like this, and ultimately my vision is I'm going to own that beverage category because I've
Hmm.
got a lot of people working behind the scenes right now on developing level two, level three, level four. And I'm going to bring a lot more traffic into your category, not just people who want water, but people who are going to be who want to look cool with drinking all
Yeah.
these other variations of my brand. It's a lot more
Yes.
leverage, as you can see, when you are selling the forest and the vision of a brand, as opposed to just selling that one tree and planting the seeds only for a can of water.
Yeah. It's brilliant. Brilliant. Great analogy. And thank you for that. I love the forest through the tree. I'm going to have to steal this, but I will credit you for this. Okay. So let's talk about maybe let's move over to the research. So I want to take it maybe to the first step. Research, research, research. What are some of your deepest recommendations for anyone out there listening on how to conduct adequate market research, whether they have big budgets or little budgets? What are some of the tools of the trade?
In the beginning stages, when you're developing a product, spend the money to understand who your consumer is. Understand your value proposition. Who would that appeal to?
Mm,
Because if you don't truly understand who's going to be interested in buying your product, and not just for the trial but for the long run, for that repeat purchase time and time again, you won't necessarily know how to design your message or create your message, the appropriate
mhm,
message, in the right channels of communication.
mm,
So I'm a big advocate of doing research to understand that. Now, I've worked with many different smaller companies that are launching products who might not have that CPG expertise on their teams. And when I say something like that, immediately they're like, oh my gosh, that's going to cost a lot of money. Not
mhm.
necessarily. These days, with technology, with AI, with small companies that can just help you run a survey, deploy a survey to 1,000 people and get some feedback. That's, a great starting point just to
Great starting
understand,
point.
right? It's a great starting point. Spend $1,000 or $2,000 just to get some survey feedback. And in that survey, I mean, I've done some where you just put some pictures of your concepts and you ask questions. Why would you buy it? Why would you not buy it? Who's the closest competitor to this product? Just things
Mm,
like that, and you understand who you're targeting. That would be definitely step one. Step two is, now that you understand your consumer, you have to understand the environment that you want to launch into. I commonly will see that brands and founders have not done sufficient research to understand who the other players are and what the other players bring to the table and
mm,
how they will make every effort to kick you out once you join the game.
yeah.
And so that type of research will require POS data, category level data, if it's accessible. So if it's a typical CPG product in retail, there are lower cost sources of POS data that you can get just to understand what's going on, what are the dynamics. So when I say dynamics, what I'm talking about is, for example, how much do these other brands invest in the category? So if
Yeah.
you're launching to a category where your competitors are investing 20, 30% every single year of top line into just the promotions and trade that you can measure, for you to come in thinking that you only have to spend 10 to 15% is unrealistic in
Yeah.
survival.
Yeah.
So doing that type of assessment analysis, you can absolutely build a more sound and well-funded plan before you go to market. So those are two areas that I would definitely start.
That is excellent. What about, when you said environment? on the competitive side that absolutely rang a bell because so very often entrepreneurs, for the forever optimist, whether they're early stage or late stage, entrepreneurs are very optimistic. Marketers are very optimistic. There's a lot of optimism in the space, and we always think we could take down Goliath because we're smarter and right. But when you start to understand the competitive landscape and this whole idea that they might be spending 20, 30% and you want to come in and spend 5, 10, it's just not going to cut it. What about from like a macro industry standpoint, global economics, things that are happening with offshoring and tariffs and kind of understanding that landscape? How do you take that in and apply that?
Well, I think the current competitive environment, the two macro factors that influence what your budget is going to look like or how deeply you're going to have to invest, I would say is going to be inflation. And inflation has been a big driving factor since, the days of COVID. And that has all been influenced by supply chain economics. And I think to this day, we're still suffering from those higher prices. And now with tariffs, with what's going on in the world, I think you have to factor that into your pro formas. You have to assume that your supply chain costs are going to continue to rise. And so when you're setting your strategy, when you're setting your pro formas, your forecast on what's going to happen, I think you have to factor that in. And I remember having conversations with some of the CFOs and the brand managers that when they've done these financials, things like price increases were never factored in into
Wow.
into their forecasts. And that is legitimately something that I said, listen, if you're anticipating that your costs are going to increase
That's
at
a
an
good point.
annual rate of 3, 4, 5, 6, 7%, then you have to equally factor in price increases at that time. Otherwise, your margins are going to just start to collapse over time.
That is an excellent point. I want to talk a little bit about the late stage companies.
Sure.
You have a lot of Fortune 500 experience and a lot of product life cycles, and you see you were kind of talking about this at the very beginning. What is it that the pros, let's say your Procter and Gamble's of the world, or Del Monte's of the world, what is it that the professionals out there, that the behemoths are doing differently that let's say 90% of the rest in CPG simply aren't doing beyond spend, because we know they have more money to spend? But is it a mindset? Is it a methodology? Is there's something that we can apply and adapt?
When you're an established CPG company, at that point, your KPI starts to lean more towards market share.
Okay.
Now, it's not as much about the metrics, about getting into the door and staying on the shelf. It becomes more of holding your share in the marketplace. And so a lot of the conversations will start around share. And why share? Because share ultimately is a measure of your brand's health. Once you take into account additions and deletions, velocities, and price changes, promotions, and at the end of the day, all of those levers are used to maintain your market share, at minimum, maintaining your market share. Of course, ultimately, your growth is to grow your market share in the long run. So I would say that once you're established and you have your products, then your goal is to make sure that you do not go backwards in your market share. And through the turmoil of competing against new entrants in the marketplace with your competitors, managing your velocities, managing your promotions, you have to make sure that your market share stays or grows. And so I think what more established brand companies do, and this isn't just CPG, but it's really any manufacturer that sells a product that is fast moving, that has lots of activity with competitors, you need to think about the life cycle of your products and your product being a part of a broader portfolio. And so in order for you to sustain market share when you're managing products with life cycles, you have to be thinking about what's going to happen, what are you going to do to hold your market share when that product ultimately hits the other side of the hump. When your product starts to decline, which all products eventually do, When that product starts to decline, what's going to happen to hold your market share? So the only way to hold that market share if your product's on the decline side is either pump a lot of money into it to bring it back up, which isn't necessarily feasible with
Hmm.
financials and economics. But that means you have to have innovation in play, ready to offset that erosion in that product. So, an established branded company will have a pipeline of innovation that's slated to be inserted once that initial product starts to reach the declines, so that at the end of the day, at minimum, your goal is to maintain that equilibrium. When one product starts to come down, you've got another product coming in to offset that for two reasons. One, you want to offset the loss in sales, but you also want to hold your place on the shelf, because once that product
Hmm.
starts to decline, you're at risk of deletion. Well, you better make sure you hold on to that slot and slide the next product right in to hold that space. So, innovation is a good way of holding that market share. Consumer campaigns, marketing campaigns, right?
Hmm.
Your next
Yeah.
big marketing campaign, whether you do it as a co marketing with some sort of public event or some sort of branded equity in
Hmm.
entertainment perhaps, but something to drive that level of interest so that you sustain. Now, ideally, your product has a really long life cycle and you don't start to hit that decline. So then when you launch your next innovation item, it becomes incremental and you
Yeah.
drive that market share up. So I think when you're an established company, your goal is less about getting those new doors, and it's more about maintaining that market share through a variety of different levers.
How does acquisitions play into this? Do you see that being a useful tool?
It is absolutely a useful tool. So if you have an established brand, you really have to think about how penetrated that brand has, that product is with your
Hmm.
universe, right? If your total accessible market is not that big and you think you've tapped out with that penetration, then the reality is acquisition for that market is not going to be high. So
Hmm.
therefore, you've got to shift that acquisition effort to another population, and it's another population that would be willing to buy your brand. Ideally, it's the same target consumer you're going after, or the same family that now has a different person in that family that would be interested in trying your product, but they've already overcome that, that brand hurdle that we talked about earlier. So acquisition, you have to determine whether it's within your total accessible market. If it is and your penetration has been low, then yeah, go after more consumers and get them to try your product. It's not cheap, of course. Acquisition is never
Sure.
cheap compared to
Hmm.
driving organic growth with established consumers, but that's where you have to do the consumer research,
Right.
right? And understand
Yeah.
if there are 10 consumers who would consider your product, how many of those consumers you already have, and what's it going to cost you to get that additional bucket of consumers to get to 10.
Yeah. Yeah. That's a good point.
When brands decide to buy another brand that's in the category to
Hmm.
leverage supply chain efficiencies, so they're able to buy another product, another brand that's in the category because they know that they have technology that they
Hmm.
want to incorporate, and
Yeah.
they're doing that to gain efficiencies in the production side. Or there's sometimes, it's not as much, but sometimes they do that to get the reputational benefits, the the retailer benefits of
Yeah.
working with an established brand. Call to mind initially, I'm sure there are some brands that I've worked with. Since I've been working with smaller brands lately, I know that there are oftentimes when bigger brands are interested in buying the buying the
Yeah.
smaller.
Right. Right.
And in those,
And what are they looking for? Like, I know what they're looking for, but maybe for our audience, when the bigger brand comes knocking on the smaller door, what is it that they're looking for?
they have the resources to scale that brand to higher levels.
Yeah.
The growth potential, the trajectory is much more attainable when you've got deeper pockets.
Yeah.
And so they see the potential. They see the potential for growth for the smaller brand. They know that if they bring their industry expertise, they bring their deep pockets into play, they can launch this brand to levels where the initial founders or the smaller company don't have the resources to do.
Yeah. Yeah.
So that's one of the key reasons why the bigger companies are interested in buying these smaller brands. And then, of course, there's the extension of the portfolio. And like you
Hmm.
said, commonly it's a way for them to reach a new consumer that they have not necessarily either invested to reach or had the entitlement to reach.
Okay. I want to take a step back here
Okay.
and go to, we've been talking about how to protect ourselves on shelf space, product life cycles, talked a lot about velocity. But what about when things are actually really working in your favor? And I feel like sometimes there's a little bit of hubris that comes in if you're like, hey, we're the bee's knees. Everything's going great. It's never going to end. Our product is going to last forever. Where does that break, right? Where does scale actually break? Which would be watchful for in very good times.
When your business starts to grow that quickly, one of the very real threats in this business is that other companies will start to replicate. And so your competitive advantage of being first to market, of being unique, that doesn't last forever. And so, with the nature of our products being fast moving consumer goods, the ability to replicate a product is quite simple. And so, when you do start to grow that quickly, one of the biggest threats is that somebody else comes in and does the exact same thing, and the fear is that the other company that comes in to do that has deeper pockets, can scale much quicker than you can, and also can leverage established relationships with retailers to get out there really fast and to start to overcome you. So that's one of the biggest risks of rapid expansion. And I would say that sometimes what also happens is when you have that type of rapid expansion, the team hasn't been invested enough to sustain that level of growth in the longer run. Because once you get to that level of growth and you start getting all this cash and all the success coming in, you really need to start to invest in the talent that understands this business. And I've seen it sometimes that doesn't always happen.
That's a good point.
That there is still a little bit of that apprehension of bringing in the right resources into the team to manage that type of growth. To think about then how do you expand the production, to think about marketing, for example. When you're establishing that growth, that means people are noticing your brand. Well, you need to build that brand into potential extensions, and you really need a team who can help you reinforce that type of growth strategy.
Are there different job titles that you would recommend get brought in at certain stages? So when this scale that you're talking about
Yeah.
starts to occur, who are some of the titles that you're seeing? Is it CMO? Is it like what is it?
I'm a little bit biased because
I
my
know, that's okay.
background, my background is a combined marketing and sales background. But foot on the, boots on the street. My
Yeah.
experience has been leaning more heavily towards sales. And so what I happen to see oftentimes is these smaller companies start out with salespeople, sales reps in the
Yeah.
marketplace.
Hmm.
But then once you start growing to that level, what there isn't a recognition of, okay, you need somebody at the head of that sales funnel to start managing sales strategy. And sales strategy means that somebody who can manage the trade of the budget, making sure that the dollars now that are being spent efficiently, and you're just not wildly throwing money into the marketplace, because that has implications as well. When you spend, is it sustainable to spend at that level? And if you're not going to spend at that level in the long run, then you need to have a strategy on how you're going to harness that back, how you're going to build your baseline sales up so that you can continue to fund at those levels. So what I oftentimes see from my biased background of being predominantly on the CPG sales side is that you start needing more trade management disciplines, and you also very much so when you become bigger like that, you need to start to hire more analytical people, because this business in CPG, data is the currency,
Yeah.
and you need people who know what to do with that currency and turn that currency into insights and actionable business plans. Because if you get to that level of growth and you don't have somebody who can speak the language of category growth and how to grow that category on behalf of the retailer, you lose equity points.
Yeah.
Because at the end of the day, in our business, when you're working with an intermediary, such as a retailer, they want to know how you're helping them to grow their overall business, not just how to grow your brand.
Yeah.
So the conversation shifts from talking about your own brand's performance to the overall category, the overall store. How are we going to partner with you, bring all of our clout, our marketing share now to help you grow this business, not just for us, but for others as well?
Well, that is actually the final part of this conversation that I want to touch upon, which
Yeah.
was how to build proper retail relationships. When I was coming up, I worked in apparel for quite some time. I had an apparel brand, and I remember we won a very large retailer, I won't say, but they had about 600 doors.
Okay.
And they started kind of throwing their weight around
Yeah.
on us and telling us what our products needed to look like. And they would give us style guides and make these colors, use these images, use this messaging. And they would really, kind of threaten us if we didn't do these things as two young guys around this young brand. It's like we just felt like we didn't have a lot of options. And then again, if you start losing sales velocity, you're pretty much out the door. Not only that, it's very expensive to get into the door in the first place
Yeah.
because of all the inventory they want and then the terms. And, it could get a little ugly. So when we talk about partnering with our retailers, sometimes it doesn't feel like a partnership at all. So how can we make it be more of a partnership where we have maybe not equal leverage, but we know what leverage we have as a brand?
There are two things that I think will give you more leverage in those types of situations. Going back to the conversation of data being the currency in this business, the more you know about what's happening in that category and what's happening with other competitors, the more leverage you have to be able to defend against any suggestion from a retail partner on what you need to do. If they're right, though, if what they're saying is correct and the data affirms what they're saying, then there really is no reason to push back on that because they do know what's best for the category. But if you had the access to the data and the data would suggest not necessarily, then you can arm yourself and defend yourself against some of those suggestions that you don't agree with by having access to that data. So that's one. The other thing is don't put all your eggs in one basket. I've worked with companies before that have elected to sell through one retailer and really just grow that business with that one retailer because that retailer has 6,000 doors in the country,
Yeah.
right? The problem is they get too much power because this is your one customer. However, if you then branch out and you make sure not that you're spreading those eggs into multiple different baskets, you now have extra leverage. Listen, if you're not going to partner with me in this way, I'm just going to have to offer it to somebody else.
Yeah. Where were you 15 years ago is my question.
Where was I 15 years ago?
When I needed this advice, where were you 15 years ago?
Our paths, unfortunately, the
Our
stars
paths
were
may
not
cross.
aligned and we had not crossed yet at that point.
So when you think about where the industry is headed, what are some of the biggest disruptions that we should be keeping an eye out for?
Really great question. From a consumer's perspective, it's actually from both. I think AI
Okay.
truly has the power to disrupt even with fast moving consumer goods. Because consumers now, it's even easier for consumers to shop around, compare and contrast, and evaluate the benefits compare this product
Right.
to this product, and if these are my goals, which product should I consider, right? That's what AI can do for a consumer. So which suggests even more so the importance of understanding your value proposition and really fine tuning your messaging to consumers to understand why your product is going to be the best to satisfy the need that they have. And all
Hmm.
of your marketing communication to focus on that message. Because if you think about it and they ask AI these questions, AI should be able to find sources that point them in the direction of your value proposition. I think the bigger disruptor is on the manufacturer and retailer side. That it is so much easier now to be able to come up with insights, to craft stories, and give any manufacturer the leverage
Hmm.
to tell a bigger story, to tell a stronger story, to dive through analytics a lot faster. Back it used to be that, yeah, when POS data came online, it was great to be able to harness. First, you had to harness the data. Once you
Hmm.
harness the data,
Right.
you have to mine through that data and come up with the insights. And what differentiated a category leader versus a non-leader was those who had the brain power to be able to translate the data into insights. Well, now
Yeah.
you've got AI that can do that for you. So I think the bigger disruptor is going to be who can make those insights actionable more quickly and turn that into a mutually beneficial value for both sides of the equation, the retailer and the manufacturer. That's who's going to win the game going forward.
I love it. I love it. That's excellent. I want to do a speed round here to close this out.
Okay, let me get my
So if
running
you were
shoes on.
going, get you some running shoes. Hey, you're a runner. If you were to give some advice here to teams of the future, what would your advice be? Your marketing teams of the future.
Oh boy. Marketing teams, of course, what I just talked about, which is start to understand the power of AI and how it could help you
Hmm.
leapfrog a couple of steps forward. I would also say don't underestimate the power of some of the OG type of
Yeah.
marketing research too, right? Like I said,
Sure.
do surveys, talk to people, talk to
Yeah.
potential
Right.
consumers, get into stores. My biggest learnings in my 30 plus years of being in this business are the days when I first started in this business and I actually worked at the stores, right? Understanding
Hmm.
how stores work,
Yep.
understanding the metrics that store operators care about, and really getting to that nitty gritty. Don't underestimate the power of that knowledge of how the business actually works at the transactional level.
What is your advice to retailers of the future?
Understand how AI can help you and how AI can help you to keep manufacturers honest
Hmm.
and how it can help you mine through the overwhelming amount of data that exists in retail, whether it's especially with e-commerce. My gosh, there's so much more data with e-commerce side of the business. I would say definitely do that, and also we're in a very volatile environment with supply chain costs. And I think there needs to be some real focus on economics, on the economy, right? Of how
Hmm.
that's going to impact your financials in the longer run. Those are probably two of the most salient points in my mind right now that retailers should be focused on.
Okay.
A more minor one too, and this would be relevant for both manufacturers and retailers, is the workforce.
Yes,
The workforce is changing
it is.
dramatically, and so with the newest generations, the motivations, the decision factors that are influencing your workforce are going to be really challenging if you still have an OG mindset of what it takes to hire people. I was just having this conversation yesterday with a guy who runs a pizza shop, and he was saying his number one problem right now is hiring the workforce.
I fully concur. That is a conversation. Okay. What is your advice to those in the media in the future? All types of media, from traditional to social. What's your advice here?
Ooh, now you're really pushing me.
Yeah.
Media, targeting consumers with media.
Hmm.
I think definitely is going to be the growth of personal, or the importance, dependence that people have on personal devices these days. Of, if your goal, if the media that you're involved with is call to action type of media where you're trying to sell products, it's really going to be to think about how to leverage those channels for the direct communication and translate that into action. So, for example, it's not just about the top of the funnel with the
Hmm.
media. You really have to think about how to migrate that consumer down that funnel through the media. And now with not just social media, but social commerce,
Hmm.
how to monetize eyeballs into purchases. I think that is one of the things that we have to really think about. And in some of the smaller companies that I've been working with, that is still something that they're trying to figure out, which is, okay, so I've got a lot of followers on TikTok, I've got a lot of followers on IG. How do I think about turning that into an actual purchase?
Hmm.
And I think that would be something that I would focus on if I was in the media related to consumer products.
Yeah, I like social commerce. I think that's a
Yeah.
really good point. Okay, last one. Advice to brands of the future, and maybe even a word of encouragement for them.
This business will never go away. Consumer products is here to stay, and that's why people like me and many other people like me have been in the business for decades and decades. That there's always going to be a market for people to buy consumer products. So it's an exciting business to be in. You just have to remain dedicated to your brand's objectives and think through that. No matter how much this business has evolved with technology, with AI or whatever, marketing is marketing, which is
Hmm.
defining your brand's value proposition, identifying your target consumers, and think of the best ways to have your value proposition to connect with the right consumers by saying the right thing and selling it through the right channel. At the end of the day, that's the basic formula. And stick to those roots and think about how you continue to drive that resonance with consumers with your brand, and it'll come. But just be true to the disciplines of marketing, or hire people like me who can
People
help
like
you
her.
who can help you bridge that between your value proposition and that purchase.
Brilliant. Well said. Excellent way to wrap a podcast here. We'll have your contact
Thank you.
information below. If you're new, please like, comment, subscribe to the channel. We do lots of conversations like this. Priscilla, you're the best and you're brilliant. Thank you
Thank
so much.
you. You're awesome as always, Tim.